Hey everyone, the stock price of Indian banking sector has been on a declining trend since the last few months now. For instance, within large cap private bank, Axis Bank is down 12% from peak, Kotak and HDFC Bank has been consolidating since last 4 years, IndusInd Bank is down 16% from peak, within PSU, SBI is down 10%, Bank of Baroda is down 15%, although ICICI Bank is in a different league altogether with near all-time high levels. Then if you look at mid-tier private banks, IDFC First is down 26% from peak, Federal Bank although is trading near all-time high. Then within small cap banking stock, RBL Bank is down 23%, South Indian Bank is down 30%, Karur Vysya on the other side is trading near all-time high. In fact, small finance stocks are down even badly. AU down 19%, Equitas down 30%, Ujjivan down 32%, Equitas down 28%, Suryodaya down 13% from the peak. Overall, barring a few banking stocks, majority of stocks have shown correction from the peak. The question is, why are banking stocks falling? And more important question, is it an opportunity to accumulate banking stocks? So I have done a detailed research on the current state of Indian banking sector and identified 4 key reasons why banking stocks are underperforming. And then I've shared my viewpoint on how you should approach the situation as an investor. But before we begin, a disclaimer that this video is only for long-term investor and not for traders, and it is not a buy or sell call on any individual stock. The idea is to share my knowledge with you all and let you decide what is best for you. Alright, let's get started. So first major challenge is slowdown in deposit growth. Recently, RBI governor has raised a serious concern on the deposit growth rate of banking sector. He says that slower deposit growth rate may create structural liquidity issue for bank. That is interesting to understand what is happening. So banks have a simple business model. They take deposit in terms of current account, saving account, fixed deposit and give a fixed interest to the depositor. Then they pass on this money to borrower via various type of loans like home loan, car loan, business loan, personal loan and so on at higher interest rate. And the difference between the interest rate of lending and deposit is bank's margin, also known as net interest margin. So let's say if the average deposit rate is 5% and average lending rate is 10%, the difference is 5%, which is the net interest margin. That's how banks make money. So what is happening is recently, it looks like the depositors have reduced depositing money in the bank. And the biggest reason is growing interest in the Indian stock market, where people are even breaking their FD and investing in stocks and mutual funds. Obviously, the amazing return from the Indian stock market in the last few years has created a lot of interest among people. And we have seen the exponential rise in number of investors and investment amount in Indian stock market. So growing interest in mutual funds, stocks and even gold for that matter has resulted in slowdown in deposit rate. Also, there is stiff competition among banks to acquire deposits. However, the borrowing rate is on a higher side where people are taking loan for various purposes. This gap between deposit and credit lending can only be sustained if it is narrow. But if this gap keeps on widening, it will potentially expose the banking system to structural liquidity issue. And it would directly impact the bank's ability to grow the loan book. Mr. Uday Kotak, founder and director of Kotak Mahindra Bank, says that India is transitioning from a nation of savers to investors, posing a long-term challenge for the banking sector, which relies on current account and saving account deposit as its primary funding resource. Now, if you look at what data is saying, as per report by CareEdge Rating, during the period ending March 2024, deposits saw 13.5% increase versus previous year, reaching 204.8 lakh crore rupees. However, the lending during the same period has surged by 20.2%, reaching 164.3 lakh crore. With deposit growth of banks being slower than credit growth, the credit deposit ratio, which tells us how much money banks are lending compared to what they have in deposit, is at highest in 10 years, hovering around 80%. A high credit to deposit ratio indicates liquidity risk and credit risk for banks. It looks like this is the worst deposit crunch since 2005, and slowdown in deposit growth could eventually impact the loan book of the bank. So that is the first reason why banking stocks are not doing well. In fact, I myself closely track the quarter results of a lot of banking stocks in my weekly video series, and I can clearly see that there's a lot of pressure on deposit growth. So this weekly video series include one exclusive video every week where I discuss potential investment ideas along with my top conviction bet, including top banking stocks where I'm investing my own money. But this series is strictly for long-term investor. In case you want to explore it, you can get the details on my website or via the join button of this YouTube channel. Then second key challenge for the bank is RBI proposal on liquidity coverage limit for banks. So RBI has recently released a draft on 25th July where they have outlined a new liquidity standard under the Basel III framework. This regulation suggests that banks will need to apply additional risk weighted to deposit made through internet and mobile banking. Now it's important to understand what is this liquidity coverage ratio, that is LCR. So when you deposit money in bank, you also withdraw it for various purposes. Especially these days due to UPI payment and mobile banking, the withdrawal rate has increased big time. So banks need to maintain a specific liquidity to meet this withdrawal demand. This money is kept in easily liquefiable assets like government treasury bills. Now this RBI's new draft proposed that banks increase this liquidity cover for stable deposit from 5 to 10%. Stable deposits are those where withdrawals are less frequent, and for less stable deposits which are more prone to withdrawal, the required liquidity cover will rise from 10% to 15%. Now it is expected that this norm would require banks to allocate an additional of 5 to 6 lakh crore rupees into government bonds. So that would again impact the credit growth of bank as they would need to increase allocation in government bond. Although it will be effective from next financial year, but this new norm has also created negativity in banking sector stocks as the expectation is that this new norm can reduce the credit growth rate in the near future. Then third reason is NIM pressure. Ideally, banks like to keep the interest on deposit at lower side and loan interest at higher side, because higher this delta between deposit rate and loan rate, higher will be bank's NIM, which is net interest margin, and higher will be the profitability. Now on one side there is a good demand for banks, but on another side the deposit growth has slowed down. That has resulted in tight liquidity. So in order to raise deposits, banks have consistently increased the interest rate on deposits, and there is intense competition for banks. So they can't increase interest rate on loan beyond a point. As a result, banks have been facing pressure on net interest margin, which is declining in the last few quarters, and that has impacted their earning growth. Going forward, this net interest margin pressure would continue to sustain for next few quarters, which will continue to put pressure on banks' earning growth. And that is one big reason why banking sector is underperforming. Then fourth reason is no scope for asset quality improvement. While asset quality of Indian banking sector is at its best level in last few decades with lowest ever NPA, that is non-performing asset, the catch is that this NPA is already at lowest level. Now if you look at the last 2 years of banking sector performance, there was a sharp growth in earning, and one of the biggest reason was sharp improvement in asset quality. However, from now there is not much scope for improvement in asset quality. Hence, earning growth won't have any positive impact from NPA. In fact, from now on there is a risk of deterioration in asset quality. Some of the banks have recently increased their provisions. At least if not deterioration, there is not much scope for improvement in asset quality, which means earning growth won't be very high. So I hope you got a fair idea why banking stocks are not doing well. As far as small finance banks are concerned, that include your AU Small Finance, Equita, Ujjivan, Utkarsh, Suryodaya Small Finance. In addition to above challenges like NIM contraction, they are facing one more challenge. It's the risk of fall in asset quality, especially in microfinance lending. So over the last few months, microfinance sector is facing a major problem of slippages, and that has impacted the profitability of small finance bank. Here please note that each small finance bank has different allocation to microfinance lending, and the impact would also vary based on the exposure to this sector. So this microfinance slippages is one key factor why small finance bank have witnessed sharper correction. Now let us discuss the final part, which is what is the expectation from banks in the near to medium term. Now going forward in the near term, everything would boil down to how banks manage this whole situation of fall in deposit growth, net interest margin pressure, and its impact on credit growth and eventually profitability. Those banks that will be able to fetch decent deposit growth without impacting the margin and asset quality will continue to do well, because there is no problem of loan growth. The problem is liquidity crunch. However, this growth should not be at the cost of deterioration in asset quality. Overall, the banking sector is expected to face these challenges for the next few quarters. But as far as medium to long-term growth is concerned, banks are the backbone of the economy. If banks' growth slows down, entire economy slows down. So eventually, banks have to do well, because Indian government and RBI do not want to compromise on economic growth. So they will have to figure out some way to put banking sector deposit growth back on track. Another expectation is that if the Indian equity market faces a slowdown in the future, a lot of investors might go back to traditional FDs and deposit. Overall, as an investor, I believe that it is certainly a tough time for banks. But I also believe that a lot of bad news is already priced into the banking stocks. Remember that you don't get good price during good times. You only get good price when the time is bad. So if you wait for the banking sector to come out of all these problems and then invest your money, banking stocks would already be touching a new high, because stock market is always forward looking. Hence, I believe that this is a good time to invest in good banking stocks in a systematic manner over the next few months, as there is a good valuation comfort and majority of bad news is already priced in. Yes, you might not see a sharp jump in stock price and it could test your patience, but those who will invest in this difficult time will eventually be rewarded in the long term. Majority of banks, especially private banks, are today available at attractive valuation. And remember that once interest rate cuts would start and FIs start investing back into the Indian market, they would like to buy strong banking stocks, because banking is one of the top sectors where FIs like to invest. So those who will keep patience and conviction to invest in good banking stocks over the next few months will be eventually rewarded in the long run. Difficult times only create good investment opportunity in fundamentally strong companies. Remember that. So this is it for this video. I hope you got a fair idea behind correction in banking stocks and what can be the right approach as an investor. If you find this video useful, do share it with your friends. Also let me know, are you adding banking stocks or waiting for more correction? I'll see you next video. Till then, take care.